All right, Mike G, you're out at a conference, a financial conference out in California right now, and I know rate cuts are a big topic of discussion. Just walk me through your thoughts.
Yeah, I'm out here. It's called Future Proof, and it's basically a big financial services conference. And you're talking about all kinds of different things, personal finance wise. But of course, you get some of the big heavy hitters from Wall Street. There's a lot of conversation happening right now amongst us about the Fed and rate cuts and how it's going to affect both the economy and the markets going forward.
And what should borrowers now consider when we factor in these rate cuts?
If you've been in the market for a home or a car, or you're looking to do some sort of renovation to your house, or you're having to put, unfortunately, money on credit cards, you've been waiting for a moment like this where rates are going to start coming down, and that's going to alleviate some of the pressure on you. So from a borrowing perspective now, there's a couple of different camps you're in. If you're taking a look at like mortgage rates, they basically peg off of long-term treasury bonds. So they've already kind of made their move down. You could see it move a little bit further, but they've already made a lot of the move at this point. But if you're somebody that's got credit card debt, or you're looking to maybe renovate your house and take out a home equity line of credit, you'll see those rates basically peg off of what the Fed here has done. And so depending on your bank is when the move will actually show up in your account. But you'll start seeing those types of rates coming down here.
And say I've been putting money aside in my savings. Do I need to now rethink how I'm going about saving my money, or am I good to continue what I've been doing?
Yeah. So, obviously, it's been really exciting here for savers because you're getting these juicy yields on your money, much better than you were getting for the decade prior to that. Now with the Fed lowering rates, it's going to bring down the yield that you're getting, the amount of interest you're going to get on the money in savings, but it's not going to collapse overnight. So it's not going to be a major thing. If you're thinking about how do I get my money in position for goals that I have over the next year or two, you still want that money secure, safe, and in savings. And so you might get a little bit less interest, but it's still the best place to keep your money.
And the investors sitting at home watching this right now may be thinking, what about me? How do I go about approaching this now? What do you have to say to investors?
Yeah, so from an investment standpoint, interest rates are one factor to consider when you're trying to figure out where to put your money. Now with lowering interest rates, we're going to start to see maybe a move back towards some traditional asset allocation, like cash versus bonds versus stocks. You ordinarily think of short-term goals needing to be put in cash, the next couple of years. Then your medium-term goals, you might want to have some fixed income that can generate a little bit better returns than cash. And then longer-term goals is where you're looking at stocks. Well, over the last couple of years, when you have these really nice, juicy yields off of cash that was basically safe money, people were starting to say, you know what, some of my intermediate or even long-term goals, I'm going to leave in cash. But now you're starting to see as those rates come down, you're not getting as much return off of cash. The yield's not as great. You'll start seeing maybe that you should start moving some of your money, that longer term money, into other asset classes. It's going to be different for each and every person because everybody's goals are different. Everybody's timeline is different. So you really need to handle this stuff on a case by case basis. Talk with your financial advisor or your financial professional to help you figure this out. But rates coming down is a really exciting thing. But remember, it's just one piece of the pie when you're trying to figure out how you're going to craft your investment strategy.
All right, Mike Giordano, financial advisor with Williams Wealth Management. We appreciate it as always, and make sure you bring some of that California sunshine back with you when you get back.
Well, just for you, Rashad.
All right, man, I appreciate it. Thank you.